Markets are at an exciting juncture. The US stock market is back at an all-time record, and it's doing that even though the bond market has seen 10-year yields go back up above 3%. And that is an offence against a very popular way for valuing the stock market known as the Fed model. So called because Alan Greenspan himself appeared to be using it when he was chairman of the Fed. Let me take you through how the Fed model was supposed to work. Now, this red line here is the 10-year Treasury yield, and the blue line is the S&P 500 earnings yield. Now, the earnings yield, to be clear about this, is effectively the inverse of the PE ratio. It's the earnings you get on a stock divided by its price. Now, the idea behind the Fed model is that by comparing these two yields, you can get a sensible way to value them. The higher the yield on bonds, then the higher the earnings yield you will require from stocks. Therefore, in theory, higher bond yields should be bad for stocks because yields move in the opposite direction from prices. Now, if you look at the long term, you can see that for a long time, these lines did indeed move very much in alignment with each other. You can see why Alan Greenspan viewed them that way. But the relationship broke down very decisively indeed at around about the turn of the century. At that point, you can see the stock market gets historically expensive, part of the dot-com bubble, even though the Fed under Greenspan had been raising rates, pushing up yields in an attempt to slow down the economy. And since then, as you can see, there's really no relationship at all between these two lines. If anything, they are moving in opposite directions. Now, part of that is, of course, down to QE. For the last decade, there has been an aggressive attempt to directly interfere with the bond market to keep bond yields low, and so you could say that part of this phenomenon of the end of the Fed model relationship is down to QE. But I think what's more important is a way in which you wouldn't expect these two lines to move together. When bond yields are rising, that implies optimism about the future for the economy. And it means, therefore, that you're expecting that higher rates will be necessary in future to curb a strong economy. If you're optimistic about the economy, then you should also be more optimistic about stocks and prepared to pay more for them. Hence, you get the phenomenon that we've had recently of a rise in both at the same time. It's a sign of returning risk appetite after years of QE, of interference. My best guess is that that is what is happening now, that there was never the strength of relationship that the Fed model implied, and that what we are seeing now in terms of a return of optimism explains what's happening in markets far better than the Fed model ever did.